The economy changes, markets rise and fall, trends come and go, but the investors who consistently build wealth follow principles that don't change, rules strong enough to survive recessions, inflation, market crashes, and everything in between. In this video, we break down the 7 timeless investing principles that work in every economic environment. No hype, no shortcuts, just the core fundamentals that actually create long-term wealth. Principle 1. Always prioritize capital protection. The first rule of wealth isn't to grow money, it's to never lose what you already have. Successful investors think in terms of risk before thinking about returns. This means diversifying your investments, avoiding anything you don't understand, never putting all your savings into one asset, building an emergency fund before buying stocks. Growing is important, but survival is essential. If you protect capital, you stay in the game long enough for compounding to work. Principle 2. Time in the market beats time in the market. Most investors fail because they try to predict the perfect entry, but history shows one truth. Long-term investing outperforms short-term guessing. Trying to time the market creates missed opportunities, panic decisions, emotional trading, and constant stress. But investing consistently through up and down cycles produces stable, strong returns over time. Principle 3. Compounding rewards the patient. Compounding isn't a strategy, it's a behavioral advantage. Money doesn't grow linearly, it grows exponentially, but only if you leave it untouched. The earlier you start and the longer you stay invested, the more powerful this effect becomes. Investing isn't about what you earn today, it's about what your money becomes decades later. Principle 4. Focus on value, not price. Price moves every second, value changes slowly. Wealth is built by focusing on company fundamentals, long-term potential, real utility, competitive advantage, and cash flow. Chasing price leads to speculation. Understanding value leads to wealth. The market can misprice things in the short run, but over time, value always wins. Principle 5. Avoid emotional decisions. Fear and greed destroy more portfolios than bad investments. Emotional investors buy because others are buying, sell because others are selling, panic during dips, overreact to news, and ignore their long-term plans. Rational investors trust their research, stay disciplined, stick to their strategy, and understand volatility is normal. The market rewards calm minds. Principle 6. Cash flow over hype. High-growth assets are exciting, but sustainable wealth often comes from assets that pay you regularly. This includes dividend-paying stocks, rental properties, index funds, bonds, digital assets with yield. Cash flowing assets create stability. They also allow your income to work independently from your time and effort. This is how financial freedom is built. Principle 7. Keep learning or stay behind. The market evolves. Investors who don't evolve with it get stuck. You don't need to be an expert, but you need to stay informed. Study how different assets work, how market cycles behave, how economic factors influence prices, how to manage risk, how to build a diversified portfolio. Knowledge compounds just like money. The more you learn, the fewer mistakes you make, and the more opportunities you recognize.